Hello and welcome everyone to today's webinar. I'm Piers Bolger, the Group CIO here of Infinity, and today I'm also joined by my colleague Dom Melchek, our Senior Portfolio Manager in Australian Equities. Today's session is all about our thoughts on the outlook for 2021 and some of the key drivers that we feel will be particularly important in the determinant of how financial markets are going to perform through 2021. I'll provide some brief opening remarks, and then I'll hand over to Dom to talk a little bit more detail regarding our thoughts around Australian equities particularly and how we've been positioning our portfolios on that side of things. Just in terms of a few housekeeping issues, we are recording this session, so it will be available on our website after today. And if you do want to ask any questions throughout the presentations, just please use the chat box down below, and we'll look to cover them off after we've spoken. If we don't get to everyone's questions over the course of today, we'll look to provide some answers and some commentary, as I said, at a later date after today's presentation. So on to today. Well, it goes without saying that 2020 has been like no other that we've seen before in our lives, and hopefully we won't see it again. I'm not sure whether or not the end of 2020 will mark the beginning of a new period, but certainly in our thoughts, as I said, it's certainly been one like no other. When we think about the health, the economic, the social and the cultural impact, it's really been quite incredible that financial market performance has been able to remain positive. Throw in a US presidential election and the uncertainty that continues to prevail across many financial markets, as well as from an economic point of view. As I said, it'd be no surprise, I think, to anyone to think that financial markets could have been, as I said, significantly deteriorating throughout the course of 2020. However, throughout all of these challenges, as you can see here from this chart, the exact opposite has actually occurred, and particularly occurred since the first quarter, the end of the first quarter, and financial markets, by and large, over the course of the second half of this year, have performed exceptionally well. And the question is, will that continue? And I think from our point of view, when you look at the chart here, just showing the performance of global asset classes, you can see really since, as I said, the late part of March, but particularly since, as I said, the second half of this year, financial market performance has been positive pretty much across every asset class. And those asset classes, mainly equity or equity-related asset classes, as you can see there, have done exceptionally well. The other point to note, we've seen a big rally in the Australian dollar over this period, predominantly, in our view, on the back of a couple of things. First and foremost, the Australian economy has weathered the storm better than what we're seeing globally. But equally, when we think about the recovery side of it, as it relates to China, and the demand on the commodity front has certainly seen that increase in the iron ore spot price as an example, and that's flowed through into the demand equally for the Aussie dollar. But by and large, asset class performance has been, in our view, very solid relative to the economic and the social and the health impact that we've seen across the globe. If we look at it in the context of Australian equities, and Dom, as I said, will touch on this in a little bit more detail throughout his part of the presentation, Australian equity performance has really sort of mirrored what we've seen on a global basis. As we sit here today, the ASX 200 is roughly around about flat for the year to date. An exceptional performance when we think that through March alone, the broad market index was down over 20% for the month of March. In February, it was down roughly around about 7%. So you can see there that we've had quite a significant snapback in the recovery since March, but equally, as I said, the second half of this year has been by and large quite a solid period for equity markets more generally in a local context. And we think certainly in the way that both the strategies and both in terms of policy is going to continue to be the case as we head into 2021. But in that context, what are the key thoughts around that? Because ultimately what we're seeing through the course of 2020 isn't necessarily going to be the same, which we all welcome, as it relates to the outlook for 2021. And we think there are 5 central themes that will form the basis in terms of how financial markets behave throughout the course of 2021. They're all interrelated, and we would say that probably the most important being the vaccine, but we would all say that they have an equally significant impact in terms of the performance that we see in regards to financial markets. Our base case remains that we are constructive on growth heading into 2021, and we're constructive on growth assets, principally equities as an example, as it relates to portfolio positioning. But I just want to touch on each of those 5 key areas. First and foremost, if we think about vaccine and the development of vaccine, we think this is probably the most important aspect associated with the ability for financial markets to move higher throughout the course of 2021. And in many instances, if we think about 2020 and what's occurred, certainly in the second half of this year, we've seen significant fiscal and monetary policy response from governments and central banks around the world. And then we've had a second leg through the development of the vaccine and the ability for the vaccine to be rolled out. We've seen, obviously, more recently in the UK, in the US, they're starting that process as well. The challenge clearly is COVID isn't behind us. We've got over 70 million cases globally. In the US, they've just touched over 300,000 deaths. There's 16 million cases, 64,000 deaths in the UK. So case numbers are continuing to grow, and obviously the significant health impact associated with COVID is also still going to be with us well into 2021. But the impact and the positive nature associated with the vaccine, we believe, will be a big driver of the ability for the global economy to move into a post-new COVID normal phase. It will obviously allow for the reopening of the global economy more broadly. We think that's generally going to be positive for financial markets. But certainly this period here that we're going, and if you look at the US and Europe particularly, there's going to be some challenges in the near term. From a rollout point of view, we think one of the benefits associated with, there are upwards of 16 firms around the world providing or looking to provide some form of a vaccine as it relates to COVID. The ability for multiple firms to be able to do that, we think, is also going to be particularly important in the ability of the vaccine to be rolled out on a global scale. We've already seen some of the challenges, both domestically and on a global footprint, in terms of how people have reacted to the vaccine, the ability for the vaccine to be able to be stored in a fridge environment as opposed to a sub-freezing environment as it relates to the Pfizer vaccine as an example, is very important in the ability for all people around the world to be able to get the vaccine and be able to be inoculated. And then ultimately, we just don't know as yet as to whether or not that will require further inoculation 6, 12 months down the track. So we do think the rollout of the vaccine is going to take some time. So in the context of this, we think that we will be living in a COVID environment all the way through 2021 and well into 2022 in our view. But the speed and the ability to be able to bring a vaccine to market, we think is a positive from a financial markets point of view. And as I said, in many instances has assisted in the further upswing in equity markets through the back end of 2020. The second element relates to the broader economic growth recovery. And as I spoke about earlier, the vaccine is going to be significantly important in the ability for the global economy to be able to reopen and for the ability of the global economy to move back into a more normalised environment. Maybe not like what it was pre-COVID back in 2019, but certainly the ability for economies to be able to grow and to reset in a post-COVID world. And the way that we think about that, probably just in the most simplistic form, if you just look at unemployment, you look at the ability for people to either move back into the workforce or find new work, we think is going to be particularly important in the context of a global recovery. And as I said, ultimately, that's going to be determined by the ability for businesses to reopen. I think one of the challenges, though, that we're going to see from an employment standpoint and ultimately in terms of personal consumption and the like, which is significant, particularly in the developed world and significant as well in developing countries, is the ability for the unemployment rates to move back to where they were on a pre-COVID basis. And you can see here just on the left-hand chart, if you're just looking at Australia's unemployment rate back in March of 2008 was roughly around about 4.5%. a decade later, after a decade of solid growth, strong performance in financial markets, the unemployment rate was hovering around about 5%. Shot up to 7%, obviously, when Australia went into a lockdown. So in our view, it's probably going to be a multi-year program in the context of the Australian economy as it relates to employment getting back to where it was even back in 2000 and June of last year, and well number of years before it gets back to where we were in 2008. You then look at the US, where unemployment peaked at just under 25 million. The context of that is going to be quite significant. And again, unemployment there is narrowing, but we're starting to see, as I said, some signs that it is starting to plateau. So the impact of significant industry changes, structural changes that we're seeing across industries, in our view, is going to slow the rebound in the employment market, and ultimately that's going to have an impact, we believe, on personal consumption, as well as obviously the fiscal support programs that we continue to believe are going to be vital in order for economic activity to be maintained as the economy starts to shift through into a post-COVID world. We think Australia is fundamentally better off than the rest of the world, simply because we've got through this in a relative sense virtually unscathed when you're comparing it to our other countries, both in the west and on the eastern side of the globe. But certainly from our perspective, there is still quite a significant amount of excess capacity. If we're just looking at the US and Australia in terms of the capacity utilisation, you can see there that we're well below where we were in a pre-COVID era. And in our view, that slack is going to continue to need support throughout 2021 and well into 2022 as well. So in the context of a recovery, we certainly view that there is going to be ongoing support required to ensure that the structural changes that we've seen at the industry level can result in growth in the employment side of things, as well as obviously ensuring that we have that excess capacity taken up. When we look at this chart, we think about this, we just don't see inflation being an issue at all in the context for both the domestic as well as the global economy over the next couple of years. But the economic growth is going to be significant in the ability for financial markets to find new and higher levels, and equally for a broader spread of diversity in the performance that we've seen across individual sectors globally. In our view, when we look at market performance, you can see quite clearly that there have been a number of winners, and not all performance across both markets as well as sectors has gone up. And Don will touch on that lack of uniformity in performance. We think that certainly the recovery, both in from an economic standpoint, will be particularly important, just to highlight that. The third element I'd like to touch on is geopolitical. And, there's clearly still some significant risks associated with global politics. And you can see here from this chart, just utilising the GPEU index, just showing that economic policy and global policy continues to remain elevated in its uncertainty heading into the back end of this year, into 2021. So we see here today, Joe Biden has finally been approved by the Electoral College, so he's now absolutely the president-elect into the US. That's now been ratified. It'll be interesting to see, as I said, with the outgoing administration, whether or not they'll provide additional support for the new Biden administration. But there are clearly significant challenges as it relates in the US, just in terms of managing COVID. As I said, 300,000 deaths just ticked over, but equally in the context of bringing the country together after what has been a very, very bruising year on a social and a cultural front. And this challenge is also facing the US administration on a global scale. And if we think about just the ability of the US to, as I said, re-engage with their key allies, both in Europe and in Asia, we think is going to be particularly important as well, not only in the context of setting the policy framework for the Biden administration, but equally in dealing with the rise of China and how, effectively the West will deal with, the new hegemonic status that China is looking towards, in our view, across Asia. And it's not to say that China isn't entitled to course its own destiny, but we do believe that, as I said, the challenges that are associated with the US administration, the policy front that it's facing into with China, it won't be able to do it alone. So in the context of, as I said, working with allies, both in Europe, in Asia, and in North America, we think is going to be particularly important. We only see that as a positive for financial markets because we think ultimately it will see a greater footing and, as I said, a greater level of cooperation, which we think will be positive in terms of the policy front going forward. We also believe that the Biden administration will be, as I said, more centrist in their approach and certainly looking to keep the lines of communication open with both China and Russia and other countries where they may be having a differing view. I think the appointments that have been made to date across the Biden administration, when you think of people like Janet Yellen, John Kerry and the like, we think, you're moving back to having, what we would say is, the adults back in charge, and in the context of having quality people there that understand the political environment, understand the nuance when dealing with other sovereign nations, we think is only a positive for US foreign policy as well as domestic policy going forward. Brexit negotiations are clearly ongoing, and there remains, significant challenges on that front, whether it be in terms of access for the Europeans to British fishing waters or just the industrial relations between the two countries on the trading front is going to, as I said, continue and be ongoing. Obviously, those talks, which were due to expire, have been extended, so hopefully there will be something on Brexit heading into Christmas and into the new year. But again, it creates a big challenge in the way that Britain and Europe work together and ultimately the individual relationships, trade relationships that may occur. And again, from our point of view, that's going to be really critical in the context of financial market performance. We've already seen a number of firms start to move their head offices of the UK into Europe as an example. So the ability for the UK to remain relevant in the context of financial markets, relevant in the context of trade, and the ability to ensure that its businesses can have access to open markets, we think is, again, very, very important in the context of financial markets. And in Australia, clearly we've seen here more recently the impact in terms of our China trade relations, in our view, clearly needs to be worked upon. The challenge that we're seeing here, roughly, if you think about it, $20 billion in terms of exports. We're seeing agriculture exports drop by roughly around about 7% estimated through the course of next year and beyond. So we're seeing a significant negative impact in regards to our relationship on the trading front, but equally as it relates to just the geopolitical and the way that we engage with China is something that Australia is going to have to deal into over the next couple of years. China, as we know, takes roughly 30% of all of our exports. It's our largest trading partner. So in the context of just the standard of living that we enjoy here in Australia is very much hinged to the ability for us to be able to maintain that growth in trade. It's critically important, as I said, for our overall standard of living, and ultimately that needs a strong relationship with China. So I think in the context of where we sit here today, that's something that's going to be particularly important over the next couple of years from an Australian point of view. So geopolitical events are going to be a big driver of financial markets. And these are only a couple that are occupying our mind at the moment. As I said, they're all interrelated in many, many elements. The relationship we have with the US and China is going to obviously have a big impact in terms of the relationship that we have directly with China on that basis. So in the context of where we sit here today, as I said, geopolitical events are going to continue to have a big impact and certainly impact the volatility of markets over the course of 2021 and beyond. The fourth one is trade. And, from our point of view, when we think about, what's occurred through 2020, and particularly when we look at financial market performance, when we have the lockdown and the closure of trade effectively on a global scale, you can see there the chart on the left-hand side, is really just showing global shipping freight volumes. And you can see there that through that period, when the global economy was in lockdown, volumes just declined significantly. There was no trade being happened, and that had a big impact on GDP and on financial market performance through that period. As the global economy started to reopen, we did start to see that pent-up demand. So hence we saw those volumes start to pick up, and we had that snap back, particularly across Asia. And then since the middle part of this year, trading volumes have been a little bit mixed. And again, we think that that's part of just some of the challenges as economies have opened and then closed again in order to try and get on top of COVID. And equally in the context of, as I said, the trading relationships, the geopolitical trading relationships that we've seen as it relates to China and the US and to other countries as well, our relationship with China in that context. So trade, in our view, is absolutely critically important in the context of how global financial markets are going to perform on the back of the ability for businesses to be able to grow, to be able to sell their product into new markets and to be able to develop new markets along those lines. And, certainly is the way that we look at it, trades and a really important element associated with how we think financial markets are going to track through 2021. If we look at global trading volume, so the chart on the right, just sort of showing that in the context of the impact of that, you can see the trading volumes have recovered quite significantly through the course of 2020 and certainly through the second half of this year, but they're still not where they were back through 2018 and 2019 particularly. So thinking about a pre-COVID environment, we're still not there yet. As I said, the importance of global trade in our view can't be misinterpreted to the extent that, as I said, it's critical in terms of where we see financial markets over the medium term. The speed of the manufacturing and service sector improvement that we saw through the second half, as I said, is really pronounced through the support programs that we saw, both in terms of fiscal, through government response, as well as what we saw through central banks on the monetary side of things. And we think this is going to continue to be a critical component part as we head into 2021 and beyond. And in fact, we think that's even going to be more so if the geopolitical side of things remain challenged, that it will really rely on individual governments and individual central banks in order to be able to provide that support to their individual economies. And then ultimately, that will have a big impact, particularly as it relates to Australia, where the Aussie dollar goes as well, and the impact that that will have, obviously, on our exports and our ability from a terms of trade point of view to be able to continue to maintain that growth outlook. So trade, from our point of view, remains a very critical component part of the financial market landscape. The final one is on policy, and there's two elements to policy in our view. A fiscal element associated with how governments have responded to the crisis and what they've done at a local level, and then ultimately a central bank response. And both of those we've seen, multifaceted throughout the course of 2020. In our view, if we look at the fiscal response on a global scale, from a financial markets point of view, you've seen a significant increase in the level of debt that governments and countries have taken on board. That has been absolutely appropriate when we think about what federal government has done here domestically, both through job seeker, job keeper programs, and continues to provide additional stimulus along those lines well into 2021. We think that that is absolutely the necessary outcome to ensure that economies can continue to grow, albeit at a slower pace. So when we look at these charts and sort of see the debt to GDP ratios, and clearly they're going to continue to grow at a reasonable clip all the way through to the middle part of this decade. From our perspective, as I said, we think that that is absolutely the appropriate response. And you can see there the chart on the right. If you're just thinking about Australia in that context, our debt to GDP ratio, roughly around about 40%, puts us well in the low bracket relative to other major nations around the world, as well as if you're just thinking about the broader G20 developed countries. You can see there that Australia's trading well below that. Now, ultimately, the challenge from the debt side of things needs to be repaid. How is it repaid? It wouldn't surprise us at all if we look through to the middle part of this decade and we do see some level of uniformity around a debt write-off. But I think that will ultimately be determined by the response and the speed by which the global economy recovers over the next couple of years. So debt, in our view, from a fiscal perspective, from a government point of view, hasn't been a bad thing. We think these are the times when governments should be looking to support their economies. Interest rates, as we know, are close to zero, if not zero, in many countries around the world. So the ability for governments to be able to borrow at, as I said, rates that they've never seen before, we continue to believe is appropriate. the growth outlook is the most important element as we see it, as it relates to the ability of economies to be able to recover, ultimately allows businesses to be able to recover, and that ultimately flows through in terms of the earnings of those businesses, that ultimately flows through in terms of their financial market performance. From an Australian point of view, as I was saying, we believe we've got plenty of headroom as it relates to the ability for us to be able to, as I said, support high levels of debt if need be. And the other advantage that Australia has is obviously a free float of the currency, as well as an independent central bank. And that's particularly important in the context of being able to provide different policy levers that will enable that to come through. So from a fiscal point of view, we see significant increases in debt. When we think about it, we think about that, as I said, as a positive, and how that then gets treated through the middle part of this decade, through the back end of this decade, just given the absolute level of debt being taken on by countries, I think that will be another conversation. But at this point in time, we think it's absolutely critical, and by and large, we think governments have done a good job. The challenge, I think, in the US, with another stimulus package still getting held up, we think will be required in the early part of the new year. So hopefully, with the new administration, there can be some agreement between the Democrats and the Republicans on that, and that it can get a deal through. It's unlikely it'll be in the $1 trillion basis that was originally put forward by the Democrats, but we do believe it will be close to, if not above $1 trillion. So certainly a sizable package. But when we look at the challenges facing the US, we think it will be absolutely critical that that does get passed and that relief does come through the broader economy. The other point from a policy point of view is central banks. And central banks right around the world, even pre-COVID, if you were looking at Europe, we saw cash rates slashed to zero, and we saw negative rates, and we were thinking about it in terms of yield curves and the like. And these charts really just sort of highlight the speed by which central banks moved. And I think this is a big point of difference when we're comparing the performance of financial markets through the GFC and the performance that we saw of financial markets over that period relative to what we saw during the first quarter of this year. And the speed by which central banks came to the fore, increased the size of their balance sheets in order to provide that liquidity into financial markets. That did two things. It made and ensured that financial markets could continue to remain liquid and open. And that was a big challenge that we saw through the GFC. And secondly, that liquidity could then obviously be passed through. It enabled businesses, if required, as well as obviously allowing individual mortgage holders and the like to be able to, as I said, refinance. So that liquidity was particularly critical in the context of providing market support. And it was one of the key reasons from our point of view as to why the market really rallied from the back end of March of this year, when the Fed stepped into the market and started, as I said, purchasing not only Treasury securities in the US, but ETF, corporate bonds. The RBA locally, as we know, has cut the rates all the way down to 10 basis points, had roughly around about a 4.5% decline in the cash rate over the last 18 months or so here locally. And we've seen the RBA enact a number of quantitative easing measures. They've targeted the yield curve in the context, and they've also been buying securities to the mid and the back end of the curve. And we had, for the first time, a 3-month cash option that was actually negative yielding in a domestic sense. So to say that Australia couldn't have a negative yield, as I said, we're now joined that club as well. So the expansion of the RBA's balance sheet, we think, is absolutely appropriate, again, to provide that support into the economy when needed. And if we think about the major 4 banks around the world, the chart on the right really does highlight that. So inclusive of the US Federal Reserve, the ECB, the Bank of Japan, and the Bank of England. So you can see there that just a significant increase, as I said, in the overall size of central banks as a percentage of GDP. It is significant. It is probably well in excess of what the banks would have ever thought they'd ever get to. But given the nature of what global economy has faced over the last 12 months or so, we think it's absolutely vital that support is maintained. And it's particularly vital as it relates to financial markets. Central banks provide that liquidity to financial markets. They enable financial markets to, as I said, remain open, and be able to transact. And as I said, that was never more relevant than what we saw through the early parts of March, and we think that that support is going to continue as is required as the global economy starts to recover from COVID. Inflation, from our point of view, on the back of the work that we've done, we just don't see that as an issue. So if we're thinking about policy changes as it relates to central banks, we think we're talking well into the middle part of this decade. If we just think about our local cash rate at 10 basis points, if we just think the average increase is somewhere in the vicinity of 0.25 when the central banks tend to move, it's going to take many, many years for cash rates to get back to what might be a new low normal. Let's call it somewhere in the vicinity of 3 to 3.5% as to what we've previously thought about from a cash rate point of view of closer to 5%. The other important element to note when we think about the performance of and the impact of rising cash rates is obviously governments around the world, as we know, have borrowed at very low rates. So for central banks globally to increase rates aggressively, we think will be a natural inhibitor to the growth outlook, simply because the interest payments the governments will need to pay on those higher rates will obviously increase. And that's going to reduce the ability for fiscal spending coming through by governments. So we think there's going to be a natural break as it relates to the ability for central banks to move rates higher over the next 5 to 10 years, in our view. Inflation, we're not seeing that dramatically in any way, shape or form. As I said, excess capacity, particularly when you think about wages being the most significant driver of core inflation. Yes, there are parts of the market, and Don will touch a little bit about that, where we're seeing that in certain sectors, but it's not uniform. So we don't see inflationary expectations as significantly negative as it relates to the need for cash rates to move higher or for bond yields to move substantially higher from today. The challenge, though, is that we don't sort of see financial market performance as it relates to cash rates and bond yields, particularly moving significantly lower either, unless we have a significant challenge to the global outlook in 2021 or beyond. A lot of the rally that we've seen has already occurred, and a lot of the solid performance that we've seen from those defensive asset classes in many instances has also occurred over the last couple of years. Our view is that that's unlikely to be maintained going forward, certainly over the next 12 to 18 months. So this leads us to our thoughts from an asset allocation point of view heading into 2021. So I said earlier in my remarks, we certainly have the view that the outlook by and large for financial markets is a positive one as we sit here today, principally led by the ability for a vaccine to be rolled out through the course of 2021 and beyond. The importance of having multiple companies provide a vaccine, we think, is absolutely critical in the ability to, as I said, get a timely response both to develop as well as developing market economies. It won't go without its challenges. As I said, we've already seen a number of the vaccines hit their own challenge in the context of efficacy and the ability to get to market. Hence, really important in the context of having multiple health providers deliver on that front. But the vaccine and the ability of the vaccine to be rolled out will be one of the most determining factors to financial market performance going forward. The second, in our view, relates to that fiscal response, that monetary policy response. We think that's going to continue to provide a backdrop associated with a recovery of global economic activity and global growth. And ultimately, we think that's going to benefit growth assets, principally equities, whether it be domestic or global, or other growth assets in the context of a portfolio framework. On the flip side to that, with cash rates at zero, lower than zero, we've got bond yields at sub 1% around the world. We don't see a significant rally in the outlook for bond or fixed income markets as we sit here today. Yes, they have provided a buffer for financial market performance and portfolio performance throughout the course of 2020. But when we think about the performance of fixed income markets, principally say more recently through September, even with that equity market sell-off, we didn't get a rally in bond markets. In our view, yields are probably close to or have reached the bottom of where they are going to be in this cycle, given the positive elements that we're seeing in other parts of financial markets, as well as what we're seeing on a vaccine front. So accordingly, from a portfolio standpoint, we're at our lowest point is where we'd like to be in regards to both our bond and our cash exposures. Our cash exposure wasn't significantly high heading into the second half of this year, but we've reduced it further, and we've selectively further reduced our exposure to bonds. The offset to that is clearly maintaining an overweight position or a higher allocation to both domestic and global equities. And on the domestic equity front, we've been selectively increasing that exposure slightly greater than what we would have from global equities. And our view around that is that even though the Australian equity market is only a small part of the broader global equity market, Australia has weathered COVID far better than many, many other countries. And in our view, that will benefit the recovery that we'll see here domestically, particularly in the small to mid-cap part of the market. But it will enable, as I said, the economy to move more broadly on a stronger footing relative to other countries, whether it be the US or the UK. And we think that there will be some operational uplift in the context of the domestic equity market relative to global equity markets. On the property and infrastructure side of things, we've really been focused on real asset exposure. We think the real asset exposure through time will continue to benefit from the demand cycle, but equally, if we do start to see some level of reflation coming back into the global economy, that's going to benefit the uptick in real asset exposure. So, as I said, the focus there has been very much both on property as well as infrastructure. As I said, we've had a slight tilt to infrastructure on that basis. The challenge for investors is that there's no perfect portfolio in the context. And as I said, as we sit here today, our fundamental view remains by and large positive relative to where we were clearly during the first quarter of this year. We think there's been a lot of positive elements. And from that perspective, we think that financial markets can continue to move higher. Whether they'll move higher at the same clip than what we've seen through the second half of this year, I think is very unlikely. But the positive developments we're seeing on multiple fronts and the support mechanisms that we're seeing on multiple fronts, we think is going to enhance the opportunity for investors to do better out of growth assets relative to defensive cash yielding assets through the course of 2021. As always, we'll look forward to chatting with you over the course of that period, but now I'll hand over to Dom to talk a little bit more about our outlook for Australian equities.
Thanks, Piers, and thanks again, everyone, for joining the call today. For the next section, I just wanted to reiterate a couple of the points that Piers made about the improvement in the economic backdrop, but really focus on the Australian market specifically. I'll then touch on how we see this flowing through to the bottom-up corporate earnings expectations heading into next year, as well as cover off, our outlook and what we're seeing in a couple of the key sectors and industries, and how we're positioned in our core Australian and small and mid-cap Australian equity portfolios. So kicking off with some of the top-down earnings drivers, you can see here a range of Australian indicators such as employment, consumer and corporate confidence, as well as housing sentiment have all recovered strongly over the past 6 months and are now either at or near multi-year highs. So even though we acknowledge that a significant level of this has been a result of the stimulus, which has been providing a solid backdrop for corporates, with the like of nearly $60 odd billion in JobKeeper payments alone coming through in the last few quarters. Pleasingly, this is actually flowing through to and supporting strong upgrades to earnings that you can see here. And this is earnings expectations for 2021. As seen here on the chart on the left, with the green line representing company earnings and the yellow line representing dividend payments, you can see that we're now seeing strongest level of upgrades since the GFC, albeit, the caveat is that we're coming off a low base, but it is still pleasingly nonetheless. These upgrades have also been the driving force behind the recent market rally, together with other things that Piers mentioned, with border reopenings and the prospect of a vaccine. But now the logical question to ask from our perspective is, have these upgrades been equal across all industries? And what might the gap be between these upgrades and the recent rallies? Ultimately, i.e., have we got ahead of ourselves in some parts of the market or the Australian market more broadly? In our view, no. Overall, we remain optimistic heading into 2021, as Piers said, with an overweight allocation to Australian equities. But we're also, cautious to not chase some of these sectors where earnings remain uncertain and valuations might be stretched now, where you can see at the top of the table here on the right-hand side, some industries having really strong 3 months gains, such as financials and energy, but we actually haven't seen as big an uplift in earnings expectations. The earnings outlook is still a little bit uncertain, so we want to make sure that, all these upgrades and all the positivity isn't equal across all parts of the sector. So with that, I thought I'd jump into a couple of the key sectors and what are we seeing and how we're positioned for this next year. So looking at commodities specifically, our outlook remains broadly positive heading into next year, particularly on the iron ore and base metal front, such as copper and nickel. Even though we don't expect iron ore prices to remain elevated, you can see here, it's much higher than expected in the left-hand chart. Expectations are for this to come back down through the course of next calendar year. However, from an Australian equity and an Australian investment perspective, we remain broadly supportive of this part of the market, believing that demand will remain strong. And we've also seen supply constraints out of Brazil with lower than expected production numbers coming out of the heavyweights such as Vale in the last couple of weeks. We're playing this position through an overweight in BHP in our core portfolio, and we've recently also added mineral resources in our small and mid-cap portfolio, which even though it's only been in for a couple of months, it stocks up already over 30%. We're also particularly bullish on copper, where consumption is expected to pick up for multiple years here on the right-hand side. And you can see that a big driving force behind this is the decarbonisation across industries such as auto and power industry, where there's a lot of lines here, but on the right-hand side, you can see a big uptick is in renewable power generation and EV, electric vehicles in the auto space, where, I think a lot of people don't actually understand what is needed to go into in terms of raw materials, just in some of these, sustainable energy plays. And take, for example, a wind turbine. It's taking close to 3 tons of copper just to build these wind turbines. So that's something that over multiple years we see these industrial metals like copper, like nickel, playing a big part across multiple industries. Turning to the banks, banks continue to look pretty boring from our perspective when it comes to the potential for growth next year. And we have remained underweight for the last 5 years, really, which has benefited us quite significantly across our portfolios. However, recently we actually have been adding to these positions, and a lot of that is on the back of improving asset quality. So this time 6 months ago, we saw a huge amount of deferred loans, both from mortgages and small businesses, you can see on the 2 right-hand charts. But the banks have actually done quite a good job in terms of working through their customer base, getting those deferrals to roll off with actually quite a reasonably low proportion of defaults or provisions needing, meaning that, a lot of clients are moving back to payments there. So from our perspective, that is a positive boost. We also saw APRA today lift their cap on dividend requirements, so the expectation for banks to improve their dividend payments into next year is also a positive, particularly touching on and thinking of the points that Piers raised about, flat to negative cash and yield plays where, dividend expectations in the Australian marketplace are improving. But the right-hand chart really, from our perspective, highlights why we're not, even though we've been, as I said, adding to the banks in the last couple of months, which has been positive, we're not going significantly overweight because the outlook for growth does remain quite subdued with, low interest rates and actually in some places negative growth rates in mortgage growth, etc. In the healthcare space, we maintain a really positive long-term view on this, and a lot of it's around key names like CSL and ResMed, which we think will benefit from future vaccine rollouts, as well as a renewed focus on respiratory health post-COVID. And you can see here on the right-hand side, the reason that we maintain a long-term positive view on the healthcare sector is that forward earnings expectations sort of high single to low double-digit earnings growth multiples over the next couple of years, which we think is far superior to a lot of other sectors and industries within the Australian marketplace. We are tempering our enthusiasm a little bit, though, heading into the first couple of months of next year when Piers mentioned the rise of the Aussie dollar on the right-hand side. A large proportion of earnings for the healthcare sector are derived in US dollars. So we expect this to have a sort of a headwind impact heading into first half results at the end of January and beginning of February next year. And so even though we maintain a long-term overweight, it is an area where we have sort of dialed back our exposure to in the last couple of months because of that high Aussie dollar. And we don't expect that trend to stop or reverse anytime soon either from an Aussie dollar to US dollar perspective. Looking at the consumer, Piers mentioned a lot of the pent-up demand that we're seeing as well as the stimulus flowing through. And so, even though we're looking forward to 2021 being hopefully better than 2020, the reality is from a consumer and movement perspective, it will probably be very similar, at least for the first half of the year, with very little to no travel, certainly not overseas. And, we can see that in the household savings ratio with the stimulus coming through. And so we expect that pent-up demand and stimulus to flow through into domestic consumer companies. And those are, we think will continue to benefit from people remaining broadly at home. And those are the likes of Bunnings, owned by Wesfarmers, a large overweight in the portfolio, as well as Officeworks. And, people are, again, with this pent-up demand and high savings ratio. I don't know if anyone's tried to buy an iPad for Christmas, pretty much sold out through to March. So those are people like Officeworks, JB Hi-Fi, etc. This technology purchasing with not much else to do is really a positive flow through. We also like specialist retailers in the space as well, such as Baby Bunting. We're seeing or hearing anecdotally yet, I haven't seen the numbers yet, but a lot of COVID kids with people at home, not much else to do. So, we think specialty retailers like Baby Bunting should and could be a beneficiary through to next year. Across the property sector, it's really been a year of have and have-nots. You can see on the left-hand chart here that there's been a bigger level of dispersion across subsectors within the property space for domestic here. You can see that really industrials and storage were the only segments of the market to eke out a really strong positive return, whereas the rest of the market was really hit by COVID. Our view on that, though, is that COVID really just accelerated some of the structural behaviour that was taking place before COVID, where traditional bricks and mortar retailers were struggling. Sydney here particularly, we were expecting a large amount of office space to come online in the next year or two, and now that's put into question what the demand for that will be with post-COVID environment. And so this is a sector where we continue to play it reasonably cautiously in terms of what will the office demand look like next year. I'm certainly not going to sit here and tell you that we know that. I think a lot of big corporates are trying to figure out what type of floor space they need. But what we think we do know is that, again, that trend pre-COVID and really accelerated through COVID is the demand for industrial space, the demand for online and e-commerce is continuing to push the likes of Amazon, etc., into finding more industrial space. And that's really benefiting stocks in both of our portfolios, such as Goodman Group in the large core portfolio and Charter Hall in the small mid-cap portfolio. And we expect those to continue to be long-term beneficiaries. Also within the property space, we expect construction to pick up as well with record low interest rates. We're seeing a really strong demand both domestically and in the US for new housing starts and permits. And we think those will benefit the likes of Lendlease and as well as James Hardie from a US perspective in terms of new housing starts. Turning to technology, probably one of the last key sectors I'll cover off today. Our view is that technology, some of the tech names have either been sold off or pretty flat in the last couple of months with a big rotation into some of these value names on the back of the prospect of a vaccine. We certainly don't think a vaccine kills out the demand for technology. And we think there's a lot of really good quality names in the tech space. And we really want to make sure we focus on those quality names that are cash flow generative, but they're not just spending a lot of money to acquire new revenue streams without proving their profitability or improving their margins. And we think that despite the prospect of a vaccine next year, this drive towards cloud and the adoption of cloud is really going to be a continuing theme, not only next year but throughout the next 5 to 10 years. And the chart here is just an example of a really core holding that we have in Xero in our small mid-cap portfolio, and their ability to drive online adoption and cloud technology through their accounting software, and they just ticked over 2 million subscribers, and we think that will continue to grow at a really solid run rate for the next couple of years. And that will benefit people like NextDC in terms of data warehousing, Megaport, which we've recently added to the small mid-cap portfolio in terms of helping businesses connect to web service providers, as well as all of the other sort of online payments and data providers there you can see in terms of Tyro and Appen, etc. So even though we've seen a bit of a flat line in the last month or two on technology, we think those that can generate cash flow will really benefit next year. So I've mentioned quite a lot of names and covered a few sectors there at high level. Just to focus more specifically on our portfolios. Our core portfolio, as I mentioned, really focus on quality here, but even though we're expecting a positive 2021, we're not, just all out growth and not all positioned for wins. We continue to advocate a diverse portfolio that we think can win in any type of environment. And pleasingly in this portfolio, you can see here on the chart that we've continued to deliver long-term alpha in terms of that portfolio. That's a rolling 3-year alpha, which is tracking at close to 3% added per annum over our benchmark. And a number of names that I've discussed there in terms of, the likes of BHP, CSL, as well as other sort of recovery names that we've been adding to in the banks, specifically NAB, which we think will benefit on the business side, as well as Transurban as mobilisation rates pick up and traffic volumes start to pick up as well. In the small cap part of the space, again, really strong long-term alpha, hopefully, and really positioned for, compelling thematics and strong growth here. Pleasingly from this portfolio, in a year where equity markets, large cap equity markets, were broadly flat to slightly negative, our small mid-cap portfolio delivered close to 10% return in that period. So hopefully highlighting there is some really compelling value to be found in the small and mid-cap space, with a number of what we would call exciting names there, and that are continuing to prove their worth in terms of, not speculative, but continuing to generate strong returns. So with that, I'll open up to questions. There's no questions coming through, but we'll leave it for a minute or so before we might wrap up then, close to getting the full hour. Okay, if there's no questions coming through, again, thanks everyone for attendance. And as always, feel free to send any questions through post this. And, we're always more than happy to talk markets and investments.